Corporate finance presentation. Leasing as a form of debt financing. Get ready, it's time to take your chance with corporate finance. A leasing type agreement can be very similar or have components that are the same as a debt financing type of situation. And the fact that we have this overlap could lead to situations where we have a substance and form type of issue. In other words, it could be possible for something to be set up in form as a lease type of agreement, but in substance, basically be a purchase and finance type of situation. For this reason, for regulatory purposes, when reporting on the financial statement in accordance with regulations such as generally accepted accounting principles, they typically want to be more transparent with the type of arrangements that are going to be basically financing type of arrangements, purchase and financing type of arrangements, and therefore we're going to have to determine which types of arrangements are going to be more in that category. We typically call them the capital leases versus the operating leases. So leasing components that can be similar to debt include, we can sign non-cancelable long-term agreements. So if we have a long-term type of agreement with a lease, then the question is, well, that's looking more and more like a purchase type of arrangement depending on how long-term the financing is and other conditions that could be in place in this lease agreement. So companies are required to fully show information related to the leasing agreements, meaning under normal regulations, such as generally accepted accounting principles, when you have the leasing arrangements, you typically need to basically list what the terms of the lease are on the footnotes. So there could be a discussion as to what the lease should look like with regards to being reported on the financial statements as well. Capital lease versus operating lease. Should the lease be shown basically as an asset and financing obligation, as might be the case with a capital lease, or just have the expense with regards to the lease payment, which might be the case for an operating lease. But you're also thinking about what should be on the footnotes with regards to the added information to the financial statements. So the FASB requires certain types of leases to be shown as long-term obligations on the company's financial statements. So in other words, if it's determined that in form the lease looks a lot less like a lease, but if it's determined in substance that the lease looks a lot less like an actual lease, even though it's a lease in form, and more like a purchase and financing situation, then the FASB is going to want, for reporting purposes, it to be reported on the financial statements, typically being kind of like a purchase and financing situation, basically putting the asset on the books and then putting the liability on the books for the obligation that has been agreed to. So notice, if you have this long-term obligation, it might be in the form of a lease, but you're basically locked into it. So it seems like that's kind of a financing type of situation if it's for, and depending on the term and whatnot, which we'll talk about shortly. Leases may be characterized as capital or financing lease or operating lease. So it could be characterized as a capital or financing lease or an operating lease. Capital or financing lease conditions. So normally the default position for a lease is like it's an operating lease normally, right? If you lease something, you consider it an operating lease unless otherwise considered. And you would think that the capital lease, then you'd have to meet these conditions in order for it to then basically be a capital lease. So that's usually how you'd kind of think about it. A normal lease, you're thinking basically operating lease. But then if it's formatted in form, in substance, more like it should be a purchase situation, then you got the capital lease kind of situation. So when would that happen? The agreement transfers the property ownership to the leasee by the end of the lease term. So if you have a long-term contract that is set up as a lease, and then you're locked into it basically, and then at the end of the contract, the property actually trades hands. Well, that looks a lot like a purchase situation because, the one person is going to end up with the property at the end, and you have a long-term contract that everybody looks like they're locked into. So again, you could put that in form as a lease, but in substance, it looks a lot like a purchase type of arrangement. So the contract has a bargain purchase price at the end of the lease. So you can imagine a situation where someone did this first option here, right? And then the government says hey, well, that looks a lot like a purchase situation and not a lease. What would the company then do if they want to then kind of treat it as an operating lease instead of a capital lease? They might try to have a bargain purchase option and say, yeah, it does at the end of the lease, it doesn't just transfer to the second party at the end of the lease. They have to actually buy it if they want to. They could buy it if they want to at the end of the lease. Well, how much does it cost to buy it at the end? $1? Well, that's a bargain purchase option, right? Because obviously $1 is insignificant with regards to the value of the property. So again, with a bargain purchase option, it looks a lot like you still have a situation where the property is trading hands at the end almost inevitably of the term. And therefore, it looks a lot like a purchase situation as opposed to a leasing tip situation, even though in form it's a lease, in actual substance, you're looking at a purchase. The term of the lease is equal to 75% or more estimated life of the leased property. So this is an area where you have to draw a line somewhere. Many times in law, you have to draw a line, because you would think that if basically you're leasing something that's a 10-year useful life type of equipment, for example, and they lease it for the entire 10 years and you're locked into leasing it for the 10 years, well, then you used it for the entire useful life and you were locked into that. So you would think that looks a lot more like a purchase type of situation. But if it was only, what if it was only for like 50% of the life? Well, then that maybe not. But where's the line then? The question of this is a legal question oftentimes. Well, where do you draw the line? And they drew the line at 75%. So they said if it's over 75%, then it looks like you're leasing it for a substantial part of the life and you're locked into that. Therefore, it looks more like a purchase type of situation. So again, kind of an arbitrary number, but that's what you have to do oftentimes when you're making a law. You got to say, okay, there it is, 75. There's the line. So the present value of the minimum lease payments is equal to 90% or more of the fair value of the leased property at lease inception. So same kind of thing here. You'd think, well, if you signed a contract and basically you're locked into making payments that are equivalent to, let's say 100% of the purchase price that you could purchase it for, then it looks a lot like a purchase type of situation and not a lease situation. So this is another area where if you were at 100%, that seems quite clear. But what if you're at like 70%? That maybe not, right? So they had to draw a line. They drew the line at the 90%. This is the one that concerns us oftentimes with our financing type of calculation, because it will require a present value type of calculation, because you're talking about lease payments that are going to happen into the future, comparing that to the current market value of whatever you're buying. If you're buying a piece of property and you could buy it now for like $200,000, but then you're going to lease it and you locked yourself into the lease for the next 20 years, then you're going to have to find a discount rate that would be appropriate to present value the lease payment and compare that then to the current purchase price to meet or look and see whether or not you meet this test. So you can see what these tests are, of course, doing. They're looking for what you would expect. They're looking for whether or not something is in substance an actual purchase situation, even though in form it has been set up as a lease situation. Now, why would a company want to do that? There could be tax benefits to setting something up as a lease situation, and possibly for financial reporting purposes, it might be one, easier, or two, they might not have it on the balance sheet, even though they may still have to report things on the footnotes. And obviously, from a regulatory standpoint, you want things to be as transparent as possible. You want people using the financial statements to have all the information necessary. You don't want something that looks kind of deceptive on there. And if something is in the form of a lease when it's actually in substance a purchase, that seems like kind of a deceptive type of thing there. So operating lease. So what is an operating lease then? Does not meet the conditions of a capital lease. So usually, most of the time when you think about a lease, you think about basically an operating lease, and the capital lease is something that if it met one of those conditions, it would have to be capital. If it doesn't meet those conditions, then if it doesn't meet a condition that would make it capital, then it would be a normal kind of operating lease, where that's an easy thing to basically account for, which is that you're just basically leasing the property and you just expense the lease payment every time you make the lease payment. So it's a little bit more straightforward on the accounting side of things as well. So it's usually a short-term lease instead of a long-term lease. So if you're talking about something that someone locked into the lease for like 1 year, then that's fairly short-term, right? If they locked into the lease for 20 years, well, that's looking a lot more like, that's a more unusual for an operating lease. That would maybe go into a situation where it might qualify for the capital lease. So is usually cancelable at the option of the leasee. So you're going to be locked in for possibly a short period of time, but it's generally going to be cancelable. So you're not usually locked in for this long period of time. You have a points in time where the leasee can basically stop the lease if they want, right? That's going to be, that flexibility is one characteristic typically of a normal operating lease. The leaser may provide for asset maintenance and upkeep. That could be actually a really good benefit as well. And you could see this if you're renting something or something like that, that the person that owns the property may then help out with the upkeep of the property because it's their property. They have an incentive to want to do that. You are renting the use of the property. And so will not require capitalization or presentation of the full obligation on the balance sheet. So when you actually set up the lease, there's nothing you really have to do. You don't have to take the present value of all the future lease payments and then put it on the books as an asset and record a liability related to it. No, all you got to do is just when you make the payments, you record the expense of the payment. So from just an accounting bookkeeping purpose, it's an easier thing to do as well. So impact on the income statement. So the capital lease is similar treatment as the purchase and finance agreement. So a capital lease, if we determine that even though this is in form a lease, they set it up as a lease, but in substance, it's actually a purchase, then we want to report it basically on the books. The idea is as if it was a purchase and financing type of situation. Well, how would you do that? You would have to basically look at the payments that they're required to pay. You basically have to present value the lease payment on the obligations under the lease, and then put it on the books as an asset, right? If it was some kind of fixed asset, you'd put it on the books as an asset and then put the other side on the books as basically a liability, as if you financed it, as if you financed the whole thing, right? That would be the general kind of idea of it. And then you'd have to deal with the situation whereas, well, if it's depreciable property, is it depreciable and whatnot when you're thinking about what's going to happen over time. And when you think about the payments, when you make the actual payments, which would be recorded as basically expense payments, then you got to then think about the imputing or what value of it should be interest versus the reduction of the principal. So it can actually get kind of complex as you do the bookkeeping going forward with regards to the capital lease. So periodic lease payments must be broken down into interest expense and reduction of capital lease liability. So once again, it's in form a lease now, but you had to put it on the books as a asset and then a financing like a loan type of situation, a liability. Then when you make the payments, you can't just expense the payments as rent expense or lease expense. Instead, you have to reduce the liability here, and you have to determine, just like it was a loan, you have to determine, which means you have to calculate, because it's probably not going to be in the lease, you have to determine how much of it should be allocated to interest, and then record the related interest expense portion of it. The lease asset may be depreciated. So now it's on the books as an asset. You're not just recording an expense each month related to the lease. You got it on the books as an asset. If it's depreciable asset, then you might have to deal, with the calculation of the depreciation as well, just like you would if it was a purchase type of situation. So operating lease, on the other hand, much more easy to deal with, records the expense deduction equal to the lease payment. So on the income statement, you don't have to put it on the books as an asset and then a lease payment. You don't have to present value the future lease payments and whatnot. You just, whenever you make the payment, record an expense to the lease payment and cash goes down. Pretty straightforward. You don't have to amortize anything and depreciate stuff. You don't have to record interest expense. So a lot easier from the bookkeeping side of things. So the leasing advantages, why lease? Can help if there is a shortage of funds or credit to purchase the asset. So if you're looking at an asset and saying, we need that asset, do we want to purchase it or do we want to lease it? Well, oftentimes if you lease it, it might be more expensive, but you're going to just make periodic payments on the lease side of things. So from a short-term cash flow perspective, it's going to take less cash in the short run. You might also only need the thing for a short period of time. You might not need it for the entire life of the fixed asset that you're thinking that you need. The obligation may be much less restrictive than a bond indenture. So if the lease obligation might not be as restrictive as basically if you financed the purchase of something possibly with a bond, may not need a down payment. So if you lease something, then you might not need to put something down, or if you do have to put something down, it might be not substantial, something that you can basically deal with, and from a cash flow perspective, and the expertise of the lessor can reduce the negative impact of obsolescence. So clearly, if you're leasing something like a forklift or something like that to do certain work, you may not be a forklift upkeep expert. So if you were to buy it, then you'd have to have someone help you to keep the forklift in prime condition. Or even something like an office printer, where you got these giant office printers, and if you buy the printer, then oftentimes if you have professional upkeep of the printer, the printer will last a lot longer, right? So if you basically were to lease it, the person who still owns the printer has the incentive to come in and take care of the thing in the way that they know how it should be taken care of, which should hopefully increase the life of the fixed asset and make life easier on you.